I'm Andrew Murphy, Co-Chief Investment Officer at Winthrop Wealth. And welcome to our 2023 Third Quarter Market Review and Outlook. Today I'll discuss the U.S. equity and fixed income markets, which were both negative in the quarter. I'll go over the economy, inflation, and Fed policy, and then I'll review our short and long-term outlook. At Winthrop Wealth, we follow a total net worth approach, which combines both comprehensive financial planning and investment management. Our investment process is designed to capitalize on the benefits of staying disciplined, opportunistic, and diversified while mitigating fees, taxes, and expenses. Please visit our website at winthropwealth.com to view our latest commentaries. As always, please contact us if you have any questions. We look forward to speaking with you soon. And now, let's get to the video.
The equity market declined in the third quarter as the S&P 500 decreased by 3.3%. But after increasing by 16.9% in the first half of 2023, the year-to-date gain is still 13.1%. The S&P is now higher by about 22% from last year's bear market low reached on October 12th. Although the market has had solid performance for the last 12 months, the S&P 500 is still 8% below its all-time high on a total return basis. The weakness in the third quarter was caused by fears over rising interest rates and the Fed's new higher for longer outlook, which we will discuss in more detail later. Only 2 of 11 sectors were positive in the quarter. Energy was the leader, as the price of WTI crude oil increased by nearly 30% to $91 per barrel. The 3 worst performing sectors of 2022 are still the top performers this year, namely consumer discretionary, technology, and communication services. These 3 sectors are the home to the Magnificent 7 stocks, which are still responsible for most of the S&P 500's gain this year, despite mixed results in the quarter. We know that the market often undergoes these violent rotations, where sectors or styles can lead one period only to lag the next. So rather than make risky concentrated bets, we prefer to construct diversified portfolios and tilt toward the areas we feel will provide the most potential benefit. Yields increased across the Treasury curve, and the 10-year Treasury rose from 3.84% to 4.58% during the quarter, the highest level since 2007. Interest rates moved higher due to the economy performing better than expected, still elevated inflation, higher oil prices, a renewed focus on the country's debt and deficit problem, the Fed's new higher for longer interest rate outlook, and their quantitative tightening program. We thought it would be helpful to discuss both short-term bonds, which have performed well, and intermediate-term bonds, which have been a challenge. Short-term bonds have closer maturities and are consequently less interest rate sensitive than intermediate or long-term fixed income securities. Short-term Treasury yields, including the 3, 6, and 12-month, are all around 5.5%, the highest level since the early 2000s. We can't be sure that 5% short-term yields will be around forever, but we are opportunistically enjoying them while they last. If interested, please speak with your advisor about our cash alternative strategy, which is designed for individuals or entities to invest excess cash in a conservative portfolio of short-term U.S. Treasuries at potentially attractive yields. The U.S. Aggregate Bond Index, or the AGG, which acts as a proxy for the intermediate investment-grade bond market, decreased by 3.2% in the third quarter, as the 10-year Treasury yield increased. Reminder that bond prices move inversely to interest rates. The bond market has now declined by 1.2% in 2023. The last 2 years have been frustrating for intermediate-term fixed income investors. Since September 1st, 2021, the AGG Bond Index has decreased by almost 15%, as the 10-year Treasury yield has increased by nearly 3.3%. Does this mean it's time to throw in the towel and abandon intermediate-term bonds as part of a diversified investment portfolio? Not in our view. All else equal, we expect intermediate-term bonds to provide positive returns in the future once yields stabilize. For investors, the good news is that the yield to maturity on the U.S. Aggregate Bond Index is now 5.4%, the highest level since 2008. Yield to maturity is defined as the estimated annualized rate of return an investor can expect on a bond if purchased today and held to maturity, assuming the issuer makes all of their interest and principal payments. So in our opinion, investors should remain patient. Future returns from the AGG Bond Index have not been this attractive in 15 years. The resiliency of the economy this year has surprised many observers, including us. Even the Fed is taking a more optimistic view and is no longer forecasting a recession this year. Real GDP growth for 2023 is now estimated at 2.1%, compared with a forecast of 0.3% at the start of the year. And while the economy has exceeded expectations due to a strong labor market and consumer spending, there are still reasons for caution, as several recessionary indicators are flashing yellow or red and inflation remains elevated. Most inflation readings have decelerated from peak levels, but the latest core PCE inflation reading, which is the Fed's preferred measure, came in at 3.9%, still well above the 2% target. The Fed acknowledges that although inflation is still too high, it is trending in the right direction. And given that, the FOMC is getting ready to turn the page from focusing on how high they should raise interest rates to concentrating on how long they should keep interest rates elevated. Recent speeches from committee members, as well as the latest summary of economic projections, indicate that the Fed is forecasting that interest rates will remain higher for longer. Currently, the Fed expects one more rate hike this year, before they cut rates by 50 basis points to 5.1% in 2024. We continue to believe that the key to economic growth is for inflation to keep trending lower, so the Fed can stop their tightening cycle before higher interest rates eventually lead to cracks in the labor market and/or the broader economy. We continue to separate our outlook into short and long-term periods. Our short-term view is now balanced after the S&P 500 experienced a 6% pullback from July 31st through the end of the quarter. Over the summer, we wrote that we were turning cautious after the market broke above its 14-month trading range and headed toward all-time highs. We expected some consolidation after the strong year-to-date performance and stated that a move back into the upper end of the recent trading range was a probable outcome. Given our cautious view at the time, many of our actively managed portfolios shifted defensively in July and August through a decrease in overall equity exposure. Now that our cautious view has been validated and the market has pulled back into its old trading range, we've upgraded our near-term view to balanced. Although we are expecting more volatility and for the market to remain range-bound for a while longer. We would turn more optimistic as inflation dissipates, the Fed stops their tightening campaign, and fundamentals improve. We would turn more cautious or pessimistic if the market were to break toward all-time highs again without fundamental support, if inflation reaccelerates, or if interest rates keep marching higher. In our view, investors with a globally diversified portfolio and a long-term time horizon should continue to remain optimistic. Markets have historically increased over time despite frequent drawdowns, as successful corporations have been able to figure out ways to generate profits through advances in innovation and productivity. To capitalize on the power of compounding, we believe in the benefits of staying disciplined, opportunistic, and diversified while striving to mitigate fees, taxes, and expenses. Disciplined by consistently applying our investment process and philosophy, which are grounded in a long-term approach. Opportunistic by rebalancing, repositioning, and tax loss harvesting to take advantage of market volatility and dislocations. Diversified so that portfolios are properly allocated across and among asset classes to enhance consistency. And mitigate fees, taxes, and expenses by striving to avoid unnecessary disbursements. In our opinion, adhering to a structured process and executing on all these components should help keep our clients on track toward pursuing their long-term objectives. Thank you for watching today's video. Please visit our website at winthropwealth.com to view all of our market commentaries.